Good evening, everyone. Welcome to our Texas A&M University Homebuyer Workshop. It's great to be with all of you this evening. Thank you so much for taking time out of your busy schedules to join us. I know it's a busy week for everyone. We're on a Wednesday night. I know we're in different time zones as well, too. So I appreciate you guys spending some time with us. This is a very interactive class that we teach throughout the year. It's offered 4 times to the Association of Former Students. And so this will be a chance for you to learn a little bit more about homeownership and to provide you with some tools and resources as you go through this journey towards homeownership and really what's probably going to be one of the biggest financial decisions you decide to make. Now, our session is very interactive, so we encourage you to ask questions of us through the chat or the Q&A function. I have both windows up on my screen, so I'll be kind of watching those through the presentation tonight. We are also recording tonight's class. So if you got a chance to look back at our class, you can certainly be able to take great notes tonight, but you'll also have a recorded version of that being sent to you tomorrow morning. We're also going to share with you all of our slides from tonight's session as well, too. So we're proud to bring this information to you. We've been in partnership with A&M for our second year, and we've had a great response from the A&M community. In fact, we've got a chance to help some of your fellow alum purchase homes throughout the year and over the last couple of years. And so we're excited to really share with you some of these tools and resources they use themselves to help on their path towards homeownership. Well, my name is Jason Maida. I'm going to be your presenter tonight, and I'm really excited to be able to share with you some of this content. I work for an organization called APM. We're a nationwide direct mortgage lender, and we provide mortgage resources across our community, across the country. Our team in particular focuses on homebuyer education to help really educate our future first-time homebuyers and just helps to make sure they understand all of their access they have to different tools that are available in their community and really teach you on, what home buying is all about. These are our talking points for this evening. We're going to talk a little bit about the housing market, also what's happening with interest rates, some of the projections for interest rates. And, today we had a big day because Federal Reserve Chair Jerome Powell actually spoke today. And we're going to talk more about what that means to you as a consumer, both today and just general day-to-day consumer activities, as well as what it looks like from a mortgage perspective. We're also going to run through a rent versus buying calculator. So if I want to kind of figure out, what's it going to look like for me to buy at some point in time, we're going to walk you through what that could look like. And then we want to spend some time talking about credit. And let's see, are we getting, let me just make sure that can you guys hear me okay? I see a raised hand here, so I want to make sure that I'm not on mute. You guys, okay, you can hear me. Okay, good. Okay, awesome. Looks like Zoom had an old window open. So we are going to talk about credit this evening as well, too. And we're going to talk a little bit about maybe some tips that you have that we can give you in credit, maybe some areas of opportunity to help lift your credit score. We also want to talk about loan programs, kind of give you a high-level look at different loan programs, a lot of the terminology that you've probably heard as you're maybe exploring home ownership. And then one of the biggest hurdles for some of our first-time buyers can be kind of saving up funds for home ownership. So I want to walk you through a savings plan to help you prepare to take on that major financial goal. We'll also talk about resources like first-time buyer programs that are available to you, the buying process. So like, where do I go from here after tonight's class? What would be my next step as a first-time buyer? We're going to walk you through the workflow. That's in the latter part of tonight's class. So you don't want to miss that as well. Then we're going to talk a little bit about how do you get started with us? How do you get connected to help build your own personalized home buying plan? Now, before we get started, it looks like I have a hand raised. And so I see a hand raised in the session. If that's just an error, I'll just go ahead and ignore it. But if you have a question, just go ahead and drop that in the chat or the Q&A, and we'll make sure to get that answered for you on air. All right. Okay, so let's go ahead and dive in and talk a little bit more about buying. Now, this is, again, going to be the biggest financial decisions you guys decide to make. And so obviously you guys understand, the significance of it because you're spending your Wednesday night with me. So in thinking about that, buying and does it make sense for me, we have to think about all the ingredients that go into home buying, the benefits, I should say. So let's think about this. We have the affordability factor, which that's a challenge for renters and homeowners, but ultimately you can control your budget when you're a homeowner. You don't have to worry about a landlord that's increasing your rent on an annualized basis. Many of our homeowners that we've helped over the last several years are now having conversations with us around refinancing, where you essentially take your existing loan that you have today and try to refinance at a lower market interest rate. So if I bought my home at 7.5% rate, today rates are 6.25, that has an opportunity to improve my overall monthly budget. And this is an asset that should grow over time. So if I purchase my home for X amount of dollars, that home goes up in value. I pay down my mortgage. I create home equity for myself. That home equity for most of us that are homeowners is our number one asset that we have. And as that asset continues to grow, that does have the opportunity to create really generational wealth for many families across the country. There is some tax benefits that also come along with owning a home. The potential tax deductibility of mortgage interest, which is big for many of us. And if you have a home ownership, or you're a homeowner, I should say, you have potential tax benefits when you decide to invest in energy efficient upgrades in your home. So when we're thinking about home ownership, especially when we're designing a budget for home ownership, like a monthly budget, we want to factor all of those benefits into the calculation, because if I'm paying $2,500 a month in rent, that doesn't measure up to the same $2,500 that I would spend as a mortgage payment. So I always encourage our clients to walk through a rent versus buying calculator. And we do this in every class that I provide across the country, because I think it helps kind of frame up things a little bit better for our first time home buyers. For our tonight's class, I want to kind of walk you guys through this calculator. And by the way, we have a lot of helpful calculators on our website, and I'm kind of screen sharing that with you right now. But there's different calculators that you guys can dive into, things like affordability, or when I want to sell my home, or maybe when I want to refinance in the future. But I want to take you through the rent versus buying calculator and give you kind of a what if scenario. I would encourage you to walk through a calculator like this on your own. I think you'll find the exercise to be super helpful. But let's say I was buying a $350,000 home, right? Well, you're going to learn tonight that the minimum down payment for a first-time buyer is 3% of your purchase price. So if I bought that $350,000 home, I had a 3% down payment. That means I'm going to finance 97% of that purchase price, which would be $339,500. We factor in an average interest rate, the term of my loan, which in this case is a 30-year fixed mortgage. And then let's make the assumption I'm going to buy my home in December, okay? Now, when we buy a home and we put less than 20% down, we are going to have mortgage insurance. And so I've put that calculation in there as well. We have things like homeowners insurance, which might not be that high in that scenario. We have property taxes. We have maybe homeowners association dues if I'm choosing to buy maybe a condo or a townhouse. And then one of the big benefits of homeownership, like I just mentioned to our class, is that tax benefits can come along with homeownership. So we would plug in what tax bracket I'm in, the cost of selling my home, how much my home is that going to appreciate over time. And then I want to compare it to someone that, in this scenario, we have someone that's paying $1,600 a month in rent. That obviously can look different for different parts of the country, but let's just use that for our exercise. And then we want to assume that we're paying renter's insurance and that our rent's going to increase by 2% on an annualized basis. So what our calculator basically tells us back is that if I went out and instead of renting for $1,600 a month, I went and bought a home for $350,000, then I have a break-even point of 3 years in ownership versus continuing to rent and probably paying someone else's mortgage payment. So that means I'm going to be on the plus side after 3 years of owning. Now, here's where it gets exciting. This is where we got to think more about home ownership, is that if I now stretch that calculator out to a 10-year outlook, after 10 years, now I have about a $77,000 buy opportunity versus deciding to rent. And again, paying someone else's probably mortgage payment that they're making on their existing loan. So that is the magic really in homeownership. And then that also kind of equates to more equity I'm going to have in my home. So my total equity over 10 years is over $180,000. And obviously everybody's situation looks a little bit different. If I'm paying less rent or more rent's probably going to be a little bit more positive for me on this calculation. But that kind of shares with you a little bit more about what goes into the ingredients of considering home ownership. I would encourage you guys, when you have some time, maybe walk through that exercise yourself. I think you'll find it to be really helpful. I'll also help you through that through our consultation service that we do in working with our home buyers. Now, I want to kind of shift our attention to talk a little bit about the housing market. We're kind of spotlight the Texas market right now, but I would ask just a quick favor from our audience. If you feel comfortable, if you want to just put where you're thinking of buying or where you reside today in the chat, we could talk a little bit about other markets, and just I'll also give you an idea of kind of where we're joining tonight's class. The association spans all across the country, so we don't want to make the assumption that you're going to be buying in Texas. But let's take a look at what's going on in Texas. And by the way, Texas is one of 4 markets that has the highest supply of homes in the market right now. That also includes Georgia, that includes Florida, that includes Colorado, believe it or not. So they're all part of kind of the highest supply of inventory out in the market. When we look specifically at Texas, we're seeing this average days on market over 2 months for most homes. That's a combination of new construction. That's also resale homes. That kind of increase in supply is also pushing down prices just a tinge. It's not a lot, but you have to only have so many buyers in the market. You have interest rates at a level that we're going to talk about in just a second, and then you have excess supply, so it is going to kind of hurt pricing a bit. So there are some really big opportunities in Texas, and I know not all of us are buying in Texas, but there definitely is an opportunity here to potentially purchase a home that's a little bit more affordable for you. Historically, we see seasons in the market, right? So usually the fall and winter time is usually the slower times in the housing market. That trend may change a little bit, especially as we're looking at what's going on with interest rates, because interest rates are starting to see some declines, which is super exciting. That's great for our home buyers. That's great for our existing homeowners to think about refinance opportunities. But just about 3 weeks ago, we hit our lowest levels in interest rates in 12 months, believe it or not. Well, today, Federal Chairman Powell spoke. You guys may have even been paying attention to that because we did see interest rates get cut 0.25%. Now, that was already assumed that was going to happen. So a lot of what we've seen in the mortgage interest rates leading up to today had already been kind of baked in. What we were more so kind of looking to see is what is the chairman going to say about future rate cuts, because that will lead to the next drop in interest rates. And as expected, I don't think it was any surprise to me at least, was that they didn't give any indication that, yeah, we're definitely going to cut rates at our next meeting. So we're going to try to kind of glean something out of today's session, but we're trying to see is what's the next move by the Federal Reserve, because that ultimately can push rates a little bit lower. The two measurements they're really looking closely at is inflation. Inflation goal for the Federal Reserve is 2%. And we're also looking at what's the strength of the labor markets. And so those are going to be the things that they're going to measure to say, hey, are we going to cut rates some more? We don't have any kind of like probability out yet in terms of what the next move is, but that next cut by the Federal Reserve, if it happens this year or early next year, obviously will send interest rates a little bit lower. So good trend on the horizon for mortgage interest rates. Is not really a question of if interest rates will go lower, it's more of a when. So as you're thinking about timing out home buying, everybody wants the lowest rates. They want the lowest price homes, right? Hard to kind of time that in the market, but ultimately interest rates are certainly going in the right direction, which will fuel a lot of the buyer activity. So you can see our kind of a look at the interest rates over the last 12 months. Today it's comfortable to say we're in the low sixes, as you can see by our chart. Now, that doesn't look a lot different than we saw back 20 years ago in the housing market. Now, the housing market was a lot cheaper back then. Homes were a fraction of the cost today. Now, as we look at this 20-year snapshot, we see kind of major economic crises. So this represents the housing crisis of 2008, 2009. Interest rates were slightly higher than they are today. That really wasn't the true issue. But then we go a little bit further on into the pandemic, we saw interest rate hit the lowest levels ever recorded, 2.5% interest rates. I bring that to our class's attention because that is highly unlikely for a repeat of a 2.5%, because the reality is, and hopefully this never happens, where we have some type of catastrophic event that has affected us globally that would send interest rates down to that level again, but that's highly unlikely. Historical averages show that interest rates are generally around high fours to low fives. So we're certainly still above that, but interest rates will continue to trend down. And we obviously monitor that on a day-to-day basis for our clients. Now, the interest rate isn't the same for everyone. Interest rates have different characteristics that make up the overall rate. That includes the credit score of a client, their eligibility for a specific product, the type of program they're going to elect, how much they decide to finance, what their down payment looks like. And I have a lot of conversations with clients around buying points to secure a lower interest rate. It's not something I would really recommend in today's market. And what a point basically means is you would pay essentially 1% of your loan amount to drop your interest rate about 0.25%. The break-even point on that in today's market is about 3 to 4 years. So not super something that I'd say, hey, that's a good win for us, because many of our clients that are buying in today's market are probably going to refinance in a couple years. So I wouldn't take my rate down from 6% to 5.75, pay all that cash out of pocket if I'm going to turn around in a year or two and decide to refinance at a rate of 5% or whatever the case may be. Also, loan term can impact our interest rate. So if I shrink my term down from a traditional 30-year fixed mortgage to, let's say, a 20-year, maybe even a 15-year mortgage product, that can also lower my interest rate. So we're going to help kind of give you guidance as we meet with you for a consultation to figure out the right design for you for your interest rate. But ultimately, there are different elements that we need to understand as a buyer that goes into that overall interest rate. Now, one of the biggest factors into interest rate selection is credit score. And every loan program has a minimum credit score. And we're showing those programs up on screen here. So that's the minimum entry point for a product based upon those credit score requirements. Now, when we look at the credit score, there are, as you guys all know, there's 3 different agencies that report out. So there's Equifax, TransUnion, and Experian. They all give us a different score because they have differing risk models, if you will. So that's why you'll see a 720 score on Experian, maybe a 740 score on Equifax, right? We take the middle score of all 3 bureaus reporting. So if my highest score is 780, let's say my middle score is 760, my lowest score is 740. Well, we're going to take that 760 score to evaluate my interest rate option, my product, as well as the cost of mortgage insurance. If I have a partner that's going to join me and maybe we're deciding to add my partner to the application, well, if my partner's at 740, 700, and 680, right? Their middle score is 700. So that's significantly lower than my middle score. So that would have an impact to interest rate, probably going to impact the cost of mortgage insurance. We have access to the same product, but the design of my financing might look a little bit different. So those are conversations we're going to have with our clients. Now, when we look at events on your credit report, things like maybe a late payment or a charge-off account, or maybe a collection that you just totally forgot on an AT&T account that just appeared, right? It's going to impact you in the most recent 12 to 24 months from when that reported to your credit bureau. So let's say I forgot to pay my student loan payment in October of last year. Well, that's within that 12 to 24 month period. So it's probably negatively impacting my score. As I move further away from the event of that credit impact, I should see some score improvement. But initially in that 12 to 24 month period of time, that's where I'm going to see the impact to my credit score. Now, looking kind of further out with negative events that have been on my credit report, things like inquiries, for example, hard inquiries can stay with you on your credit report for 2 years. The impact to your score is within the most recent 6 to 12 months. Okay, that's a little bit different for inquiries. Now, one of our kind of a unique approaches in how we design options for clients is we only start with a soft credit check when it comes to helping our clients with their home financing. Okay, so we help you design your home buying, get you a plan put together, but we only do a soft credit check. Now, there are rules in place for both auto financing and mortgage financing that allow you a 30-day window of time to do your shopping with different creditors. But it essentially gives you that 30-day window, and it's the equivalent of one credit inquiry impact to your score. But in our approach, like I said, it's a little bit different. We like to do a soft credit check so you can shop with ease and convenience for your home, but not have the impact to your score. All right, now there's 3 different models to credit scoring. There's auto financing has a model, there's credit card model, and then guess what? On the home financing side for your home purchase, there's a mortgage model. Now, for those of you that subscribe to monitoring services like Credit Karma or any of the other tools that you're connected with, they use a credit card model. And that's important because many of our clients that come to us for their consultation, we'll have a conversation. They're like, hey, Jason, Credit Karma says I'm at 760. Why are you showing me at 755? Well, the reason why is there's a different model that's being used. Okay. Now, this model that we see on screen here is the mortgage model. So it has different weightings for different areas of the credit. And so I'm going to kind of just walk our class through these different areas because I think what I've found in teaching this in our classes throughout the year is that as you see different areas here, you might identify an area of opportunity for you. And the first one is length of credit. So not much you can do there other than continue to let your credit season out and avoid new opening of accounts. But ultimately, the longer I've had my credit file, better improvement I'm going to have in my score. 20% is going to be how much new credit am I trying to get access to? So am I opening a bunch of new accounts, especially in the most recent 6 to 12 months? Do I have hard inquiries occurring on my credit report? Like I mentioned to you earlier, that's 20% of the credit score weighting. And then probably the biggest area of opportunity is credit utilization or revolving credit. That means what do I have in outstanding credit limits that I have access to versus what are my credit balances right now? So if I have $10,000 in credit limits, my balances are $8,000. I'm now at 80% utilization of those credit limits. So I'm probably seeing some pullback in my credit score. So my kind of coaching for a client would be like, okay, let's get below 50% or $5,000 in balances. Once we kind of achieve that level, let's get to $3,000 in balances. And then my optimal level, those that are at the 800 plus credit score probably have 10% or less utilization or $1,000 less on those balances. Let me give you a tip how to manage credit card debt to maximize your credit score. And it's a really simple thing, but if you looked at one of your credit card statements, you have two dates. You have your due date, which we all know about, but there's the activities or statement date. That's for the previous 30 days of cycle on the credit report. So your tip for tonight is that if you can pay down or reduce down those balances before the end of the activity or statement closeout date, what happens is you're going to catch the creditor before they report out to the credit agencies, therefore getting a lower balance, lower utilization, hopefully, and then improving your credit score. Highly encourage you to do that, especially as you're getting ready to apply for anything, specifically a mortgage. Now, we'll help you through some credit coaching as part of our consultation service. So you're going to learn more about that in just a bit. So we'll identify those areas of opportunity if you need help with that. But that's a great kind of low-hanging fruit opportunity for many clients. And then finally, there's payment history, and that's pretty self-explanatory, right? How have I paid my bills? So the more on-time history I have over a longer period of time, the better I'm going to have my credit score. If I've had some, kind of blemishes, if you will, on my credit report, it's going to be rated as 30-day lates. So that's the number of days I've been late, 60-day lates, and then 90-plus day delinquencies. Especially in the most recent 12 to 24 months, that's going to have the bigger impact to my credit score. All right. Now, I want to kind of just stay within credit and talk really quickly about student loans. It's a conversation that comes up at least once or twice a day as I work with my clients. And that is just looking at and assessing student loan debt. Now, some of us on tonight's session may have forbearance on their student loans or deferment. So if you're in one of those statuses today, we do have to count a minimum payment for qualifying. And that is by default 0.5% of the outstanding balances for an FHA loan. So in our scenario on screen, if you had $75,000 in student loan debt, I would count a $375 payment on your qualifying. If you were doing a conventional loan and you're in forbearance or deferment, it would be $750 counted as the monthly payment if you had that amount of debt. Now, some of us are in savings plans right now, income-based repayment driven programs. That is totally fine in financing. If you're in a program like that and you have that same amount of debt and you're paying $250 a month, then that can be used for qualifying purposes right now. The challenge we find right now is we're seeing some student loan servicers switch servicing. So they're kind of those accounts becoming a little bit in limbo. More importantly, we have a lot of clients that are applying for mortgages right now and they're still in deferment or forbearance and don't realize that we still have to activate some type of payment when it comes to qualifying. Okay. And we'll help you through that, but I think it's important to understand kind of the lens that we have from a lender perspective. So question came up in the chat, which is what is a good amount of time to wait between opening new lines of credit, I guess in between other accounts. So I would really try to avoid not opening more than one or two accounts in that 6 to 12 month time period. So, generally I would say, and this is my own kind of personal approach to it, I only keep 2 to 3 credit cards active. I think A, it's too tough to manage, and B, with identity theft and privacy and stuff like that, I just don't want that many accounts out there. So I think in the perfect world, if you can keep 2 to 3 accounts active in the credit card space, I think that's totally sufficient. Okay, thanks for that question. So you learned a little bit about student loans, and the reason why we have to identify student loans and what those payments look like is because every program that we work with has guidelines attached to it, and they basically identify how we have to measure those student loans and factor those into the qualifying for a client. So I want to take some time, as I mentioned earlier to you in our talking points, is go over like a 10,000 foot view of every loan program, just the 5 core programs that we offer typically to our first time buyers. And so we'll start first of all with the conventional loan, which is around Fannie Mae and Freddie Mac guidelines. It does have a minimum down payment of 3%. You can see our credit score minimums there. Now, there is a maximum conforming loan limit. In fact, it just got updated from 806,500 to like 819. That's for every market across the country. But if you're in a high cost of living market, so I think I saw some in the chat in California, Northern Virginia, you're probably in a high cost of living market, depending on what county you're in. That does allow us to go to higher loan amounts, but the minimum down payment now rises from 3% to 5% if you're buying in a high cost of living area. So with the conventional loan, that is going to follow the Fannie Mae and Freddie Mac guidelines. And so the next product is FHA. That is a government insured loan. FHA stands for the Federal Housing Administration. You can see the minimum down payment here, minimum credit score, and then the maximum loan amount's a little bit different because it changes by the county that you're going to buy in. All right. And just like to my point earlier, there are high cost of living area markets. So if I'm in LA County, for example, on the West Coast, that FHA loan amount can go as high as $1 million too. And then I want to kind of connect these two products here. These are both government insured products. The other product is a USDA loan, which essentially is another government insured product that allows clients to buy in more rural areas. So if you're thinking about buying in kind of more of a remote area, the benefit of doing that, as long as it's identified as USDA eligible, is that you get a zero down payment option. And the loan amount that we can provide to you in those markets will be dictated by the county that the property resides in. Okay. Now, the two changes we saw in both the FHA and USDA product relates to residency. So you have to be a permanent resident, unfortunately, to access any of the government insured products. The residency status has not changed with conventional loans, so you can be a non-permanent resident and still tap into Fannie Mae and Freddie Mac resources. The jumbo loan is going to be for clients, not typical for first-time buyers, but it does allow a little bit more funding capacity for someone that needs to kind of get financing above and beyond some of the agency limits, but it does have higher down payment requirements, higher credit score requirements. And then finally, for our veterans that have eligibility, we have the VA home loan that has a zero down payment option. You have a minimum credit score, as you can see on screen. There's really no maximum loan amount for the VA product. It is reserved for veterans that have a certificate of eligibility that indicates they do, in fact, have eligibility for the VA home loan. The VA product has a lot more flexibility to support entry to homeownership for the veteran, a little bit more relaxed expense versus income guidelines. So a great tool to help our veterans. Now, the conventional loan, FHA, VA, even the USDA loan will also be compatible with most first-time buyer programs all across the country. Okay, so we're going to kind of continue on with our product conversation, but I want to talk more now about mortgage insurance. And there's a little bit of misconception out there around what is mortgage insurance, how does it work, how much does it cost? So there's two lanes, if you will, in mortgage insurance. There's private mortgage insurance, which falls in line with the conventional loan. There's also mortgage insurance premium, which is part of an FHA loan, the government insured loan we just had a discussion about. Now, both insurances essentially provide protection to the lender against default of the buyer. So it is something that a consumer pays for, but it ultimately is protecting the lender against default. Now, on a conventional loan, the way that premium is created is based upon your down payment, your credit score, and then how much you finance. So the higher I can elevate credit score, the more I can put down, the cheaper my cost is going to be for mortgage insurance. One of the benefits with a conventional PMI option is you do have a cancellation option once you reach 2 years in the loan and you have 20 to 22% equity. Some of you that have been doing some searching already before tonight's class on Redfin or Zillow, maybe you started to do some payment analysis. A lot of their calculators that I've seen online don't necessarily map to an exact PMI. A lot of our calculators that I showed you earlier are a great tool to help you kind of see that a little more clearly. This is an example down at the bottom of our screen where you can see someone that's financing $300,000 with a 740 credit score and a 3% down payment. So that mortgage insurance is $92 a month, not as expensive as you might think. And then the higher I can push my credit score, the cheaper my mortgage insurance is going to be. FHA works a little bit different. There's two forms of mortgage insurance. There's both monthly mortgage insurance that we calculate at 0.55% of the loan amount. And then there's upfront mortgage insurance, which is 1.75% of my loan amount. Now, different than the conventional product, the FHA loan does not have a cancellation option. So really the only way for me to exit out of mortgage insurance with FHA is I'm going to have to refinance out of that FHA product into more of a conventional type loan. So as I think about the FHA product, it's going to be an option for our clients to get access to home ownership because it does have a lot more flexibility and guidelines that we would see in the conventional loan. Things like maybe past late payments or lower credit scores or higher expenses versus income ratios that we're going to talk about later tonight. Like all those things will allow FHA to be a great resource for our buyers, but it's probably not the forever loan for most of our clients. Now, if we look at the payment structure now with the FHA product, we have that same $300,000 loan amount. We have the upfront mortgage insurance that gets tacked on, and then we have monthly mortgage insurance, which is the $137 per month. So that just gives you kind of an idea of the difference in expense structures between the two products. But certainly, as we get a chance to meet with you, design your customized home buying plan, we're going to figure out what's the right product based upon your goals, objectives of home ownership, of course, and your eligibility for a specific product. All right. Now we're going to talk a little bit about income. I know I'm throwing a lot of concepts at you guys, but I want to take a quick pause there before we talk a little bit about income and some of the scenarios that we run across in home buying. I just want to kind of open up the floor. Any questions so far from our group? I know I had one question come in, but I want to make sure I'm not going too fast for our class. Okay. All right. And feel free, you can just drop those in the chat if you do have something. Now, I want to talk a little bit about income. And so in financing, we evaluate income and determine, eligibility. Because what we're going to do is we're going to map that against your expenses. We got to make sure that, we're buying in an affordable and qualifying position. Before we talk a little bit about income, I want to kind of share with you the typical documents that are needed in the home buying process. We get a lot of questions of like, what are documents I should prepare? This is generally what we're going to need as we process your application for eligibility. Okay. Now, let's talk a little bit about employment or income scenarios. Now, in financing, we do have to verify or validate the last 2 years of work history, but that also can include educational background. So let's say I graduated from A&M in the spring. I just started my job in September and I'm actively working, but I've only been on the job for a couple months, right? We can still use your current income for qualifying as long as I can piece together 2 years of work and or educational history. So that's not a hurdle that we can't overcome with that type of work history. Even in scenarios where I'm looking to, let's say, start a new job, right? I have a job offer that starts on December 1st. I have an executed employment offer letter. If we can verify 2 years of work history, either at my current job and my previous or educational background, we can use that new executed offer letter to qualify someone for their future home purchase. So, obviously, if somebody's taking a new job, they probably have higher income, which will lead to hopefully better qualifying for them. Now, the 2-year rule that we look at in lending looks a little bit different for our self-employed clients. So if you're self-employed, we do have to show that you've been actively or have had your business essentially with 2 years of tax filing. So the clients I'm working with right now, we'd have to see that they've filed 24 and their 23 taxes as a self-employed individual. If I am in a situation where I have a base salary, but then I also have like these variable compensation components like bonuses or RSUs or commissions, now that's a case where I would have to show that I've been with my employer 2 years. So we can look at the consistency of those earnings and then average it over 2 years. If I'm working for 2 different employers, let's say I work in the healthcare industry and I work for 2 different clinics, right? I support 2 different organizations. In that case, I do have to show that I've been working with both jobs simultaneously for the last 2 years. All right. And so I also get questions around folks that are like working for or driving for Uber or Lyft or DoorDash on their off time, but they have a 40-hour work week job. Well, Uber and Lyft pay us 1099, so it's kind of self-employment income. I can count that income with the assumption that they've been doing both jobs simultaneously for 2 years. All right. And then another question that comes up a lot is that we have situations where one person is going to apply for the mortgage, but they're also getting contributions from a partner that may not be part of the transaction, right? And they want to count their income. Unfortunately, we can't count income unless that person, that partner, is going to be part of the application for eligibility. All right. So that's kind of a look at some different scenarios that we come across in lending. Ultimately, we're going to kind of provide you some guidance as we review your application and prepare and kind of structure your financing, but hopefully that gives you some insight as to how we look at income. Now, we also look at income versus expenses, and we call that debt to income ratio. And essentially what we're looking at is today's expenses. So credit cards, car loans, personal loans, all that kind of stuff. Then we're also going to look at your projected housing payment. Now, we're going to exclude your existing rent because the assumption is you're going to move into this new house. So we look at that projected rent and then today's expenses. So for example, if I have my principal and interest and my taxes and my insurance for my new home, plus maybe some mortgage insurance, maybe I'm buying a condo and I have a $300 HOA fee. So that all gets factored into the equation. And so we have an example here on screen that you can see. So if we have someone that's paying, let's say $2,500 a month, their debts today are $500. And then they make $8,500 a month. A debt to income ratio calculation tells us that 35.3% of their pre-tax income is going to go out to the new housing expense and their current debts. So the question I get from our clients that I work with is, Jason, what's the sweet spot, or what's the comfort zone for most buyers? Well, what we've found is about 33 to 36% is kind of the comfort zone in working with thousands of buyers across the country. It's usually 33 to 36%. However, underwriting guidelines, lenders like ourselves, we can go as high as 45, even 50%. Now that starts to get a little comfortable at those higher levels, but we may have scenarios for our clients that they have other sources of income, or maybe we just can't validate all the income. So that may lead us to go to higher debt to income ratio levels. All right. Now, as we think about this metric, it's used for qualifying purposes, but it doesn't indicate affordability. Affordability is a conversation that you and I are going to have as we build your home buying plan, right? So if 2,500 feels like that's a little steep for me, Jason, I think I need to be good at 2,100 a month. That's a conversation that we're going to have to make sure that we have you in the best possible position, because we want success in home ownership. We want it to be sustainable. We want it to be affordable over time. And so, that's really important in our conversations. Now, many of our clients can qualify for $400,000, but maybe the sales price needs to be $325,000. All right. And I think Ken's taken one of our questions that came in the chat, so I'll kind of keep it moving here. I think there's a question around USDA, so we can expand on that if you need to. Last component to our conversation in building a plan really is around savings for home ownership. And that is probably one of the more challenging things for some of our buyers, because as we prepare for home ownership, maybe we're just new in our careers. Maybe we're just kind of trying to get through the challenges of general affordability in today's market across the country. And so, saving up for home ownership can be challenging. Now, we're going to talk a little bit about first-time buyer programs in just a minute. But before we do that, I want to pass along two things to you. One is I want to kind of share with you guys what the typical sources of down payment that we can utilize in financing, because we get a lot of questions around that. And I also want to walk you through a savings plan to home ownership. And so let's talk a little bit about what sources can we access for home ownership. One is we can use cash accounts like checking and savings accounts. Cash accounts per se, like $5,000 in unsourced account or unsourced funds cannot be used. But we can use a checking and savings account, but we have to make sure that those funds in that account are seasoned 60 days. 401ks, 403bs, those all can be used. Even brokerage accounts. I always encourage our clients, talk to your financial or even your tax advisor before you access those assets, so we're not creating some issues for yourself. And then gift funds can also be used. That's where a family member is contributing towards your home purchase. Now, with gift funds, there is no seasoning requirement. We just have to document how those funds are being transferred to you. All right, and I see your question in the chat, so I'm gonna get that in just a second, but I do wanna walk our class through a savings plan to home ownership, because again, savings is probably one of the biggest challenges for home ownership. So here's a really simple approach to help building that nest egg towards home ownership. And it looks a little bit like this. So if we're working together to build a plan, and let's say you're currently at $1,500 a month in rent payment, right? But you have a great job, you're making good income, you feel like you're making a lot of strides in your finances, and you feel like your projected mortgage payment can get to about $3,000 a month, and that's going to get you to the home that really works for you. Well, my coaching or encouragement for our client would be, let's see if we can start saving like we're making that $3,000 mortgage payment today. So on the first of the month, so November 1st is right around the corner, right? I pay my $1,500 to my landlord, all done there. But I also create that discipline where an additional $1,500 gets transferred right to my savings account. And I know it's a stretch, but it helps prepare us for home ownership, because then after 6 months, we have $9,000 built up over time. At the end of the year, we have $18,000. And so it's not only creating that discipline of savings for yourself, but it's also helping with that kind of transition to home ownership. So it doesn't feel like such a big jump or a shock to you when you have to start making that mortgage payment. Really simple approach, but it is very effective. In fact, we have a client that's signing their loan documents right now as we speak in California. They applied that approach 16 months ago, and guess what? They're buying the home of their dreams today. So it can happen. Encourage you to take that really simple approach, but I think it's a really effective one at the same time. So I'm going to take a question before we talk a little bit about one of the Texas State affordable programs and some other first-time buyer options. I know Ken helped out in the chat, but I'm going to kind of put it on air here, which is, how would a lender look at a couple if one person's credit score is in the mid upper 700s, but their fiance is in the mid to upper 600s due to some late payments, but at the same time, the lower score individual earns in the mid 200s, so on and so forth. So We talked a little bit about that earlier around our credit segment, which is we are going to have to look at the lowest credit score between both borrowers. So even if the lower credit score customer has the higher earning, we're still going to have to base everything off that lower credit score. So, we'll have to kind of meet with you to figure out what's the right product design. If we're in the lower 600s in credit score, we might want to consider FHA as a short-term solution. Or maybe we're talking about maybe some credit enhancements that you can do depending on your timeline for buying. So that's a really good conversation to have in a consultation with us. I mean, that's where that's what I do throughout the day if I'm not teaching classes, is like kind of working on home buying plans like that. All right, so let's talk a little bit about first-time home buyer programs. I know a few of you are in Texas, and I thought it would be important to pass along which I think is a really cool program. It's called the Texas State Affordable Program. It can provide up to 5% in assistance towards your home purchase, whether that's with an FHA loan, USDA, or a conventional loan. The assistance is a grant or forgivable loan after 5 years. There also is some special incentives for military, first responders. You can see teachers and others. And this one is one of the other added benefits is with the Texas State Affordable Program, there is a mortgage credit certificate available in Texas, which allows you to get a tax credit of up to 15% of the interest you pay on your mortgage for the life of your loan. And so that's a really cool option. Most states don't have access to that. I know in California, for example, that was disbanded like 7 years ago. So that's a really cool option. And I know not all of you are looking to buy in Texas, but I will say there are similar products available in your local market. I would encourage you to get connected with me after today's workshop because we can kind of talk more about some of the agencies that are available to you. They're essentially designed to support low to moderate income homeownership. Now, nationally, there are things like the Freddie Mac Borrow Smart program that is designed for more low-income housing buyers. So a low-income housing buyer is someone that makes less than 80% of the median income. There's also the very low income, which I think is below 60% of the median income. Now, within APM, we do have a pathway program for our FHA clients that allows you to borrow anywhere between 3.5% to 5% of your sales price in assistance funds. That's a great option for you as well. One of the benefits with the pathway program as compared to some of the other first-time buyer programs, there are going to be income limitations with some of the state or local community-run programs. Pathway does not have any type of income limits. Okay. And I saw in the chat someone put, does Kentucky or Tennessee have MCC or something similar? Let me kind of check that out. I don't know off the top of my head if they do have a similar MCC. I know they do have some type of variation of a first-time buyer program. We can circle back with you on a mortgage credit certificate. Yeah, most states don't have MCCs, or I shouldn't say not all states have MCCs. So if you can get access to that, I think it's a great way of creating affordability in home ownership. All right. So I know we have all our classes sticking around. I appreciate it because we're going to probably go through one of the most important steps or discussions, if you will, now in our class, which is like the buying process. Like, what do I do? And that's probably one of our biggest questions, aside from maybe assistance programs that I get throughout the year from clients. So where do I go from here after tonight's class? Well, you've heard me mention it a few times, and that is to get connected with us for a free consultation. That's where I get a chance to meet with you for a 30-minute virtual session. So we get together like this in a Zoom format, design a home buying plan for you, understand where some opportunities lie within credit, talk about savings plans, really ultimately design a homeownership plan for you, whatever your timeline looks like. Whether you want to buy this year, which is probably don't have a lot of time to buy this year, but maybe it's a 26-year goal, a 26 goal, or maybe it's beyond, right? Maybe it's 2 to 3 years out from here. But at least we can put the blueprint together for you in home buying. Now, our clients that meet with us for a consultation may choose to get pre-approved. And a pre-approval creates that baseline for eligibility and then allows you to start home shopping. Now, a pre-approval is good for 60 days, but it can be recertified at any time. So as we move from consultation, pre-approval, now we get into the house hunting phase, right? That is, one that's probably going to start on an online basis, and you're going to start kind of getting some filters together, some search criteria, and then start looking at homes in the market physically, right? We encourage clients to work with a local realtor. They should be experts in their local communities, understand all of the key metrics that are really important to you in making a financial decision to purchase your home. We do have preferred realtors that we work with across the country. So sometimes we'll recommend clients to connect with some of our preferred realtors if it makes sense for them. Now, as they go out and do their house hunting and they identify a home that they see kind of checks all the boxes, Then they'll make an offer on that home. And, they may not get an acceptance of offer the first time. It may take 2 or 3 times. Sometimes I've had clients that it's take 1 to 2 years to find that right home that works for their family. But ultimately, once they go under contract with a seller, then we move to step 3. That's called entering escrow. Has different kind of terminology across the country, but once you go under a contract with a seller, then that starts the escrow phase of the process. In most parts of the country, it's a 30-day process. So to go from accepted offer to getting the keys to your house, it takes about 30 days. It can be shorter in other markets. Some of us that are going to purchase in California, sometimes it's short as 14 days. If you're in Georgia, we're doing a 25-day closing. So it varies in different markets, but ultimately that kind of starts that process forward at Enter Escrow. Now, the day your offer gets accepted, you're going to get a call from me saying, hey, congratulations, you did it. Your offer is accepted. Let me walk you through some of the next steps that you should expect as a buyer. And then let's schedule you for your virtual session. So now we can kind of take all the stuff that we reviewed during your pre-approval. Let's now look at real-time numbers now that you have an agreement with the seller. And that's where I meet with every buyer across the country for 30 to 45 minutes to make sure that we're in a good position. Now, within 2 to 3 days of your accepted offer, most parts of the country, you will be making an earnest money deposit. I always say an earnest money deposit is usually 1 to 2% of the purchase price, but it can really vary depending on what you negotiate with the seller. In your deposit, those funds are going to count towards your total out-of-pocket, things like your down payment to buy your house, closing costs to buy your house. And most contracts will have some type of contingency to that deposit, which basically says, hey, I can do my investigative or research work on this home once I'm under contract, like getting my house appraised, getting my inspections done on my house, and then getting my loan approved. So usually in most parts of the country, that inspection period can be anywhere between 7 days to 30 days. But you as a buyer just need to understand that deposit gets protected while you're in that contingency period. As we move along in the process and we reach different milestones, you're going to be getting disclosures sent to you. There's usually 3 different sets of disclosures sent to us as the lender, sent by us as a lender. There's your initial disclosures that go out to you within 72 hours of our follow-up session. There's redisclosures that go out to you once we lock in your interest rate, and then final closing disclosures that go out 3 days prior to you closing your loan. Now, we talked earlier about interest rates, and I think it's important to understand that interest rates change by the minute. So the interest rates were one level today before the Federal Reserve spoke. By the close of business at 2 o'clock, they looked a little bit different, right? And so once you go under contract with the seller, we're going to strategically watch the market to try to time things to make sure we can secure the lowest interest rate for you. That's one of the value adds that we provide in working with our clients. It's not just here's your interest rate, do you like it or not? It's strategically watching the markets because we're always in tune on what's happening with economic news and who's saying what in the economy. Step 4 is going to be the administrative functions of the loan. That's verifying your employment, assets, credit check. At that time, we're going to be doing your hard credit check at that time. And we're essentially getting everything kind of built together for your financing so we can go into underwriting and get your loan approved. Now, that loan approval gets issued. We also have your appraisal back to determine the value, make sure that's all good. And once we've had that approval in place, within a few days of that approval being issued, we're going to issue a final closing disclosure. It does give you a 3-day cooling off period before you get to your final milestone, which is closing the loan. And so at the closing of the loan phase, that's kind of the last in-person component of the home buying process. Really, we don't need you in person for anything until you get to the final stages. Everything else is done e-signature. On that date of closing, you'll be signing documents in person with a public notary, maybe an attorney, maybe a title or escrow officer. You'll also deliver your final funds at that time, okay? That money gets all balanced out by that escrow or a title team, and then the funds for your mortgage also get added in as well. Those funds get all reconciled, and then they record documents with the county recorder's office to transfer the ownership as well as to record the deed for the loan, okay? And then that really takes us to the final step, which is really to call you and say, hey, congratulations, you did it. High five, virtual high five. You are now a homeowner. And I got a chance to make a couple calls like that today. By far the best part of my day, of course, aside from teaching classes like this, but it truly is a huge accomplishment. But our relationships with our clients don't end there. I mean, we have an aftercare program where we're staying connected with our clients to monitor interest rates for refinancing opportunities, providing them calculators to, accelerate equity position on their homes, and always kind of checking in with our clients just to see what's happening financially, if we can be of any service to them, right? As we're wrapping up tonight's class, we're gonna have a little bit of time for some Q&A, but I also want to give you some of the steps to get started. So whenever you feel like the time is right and you want to kind of learn more about your options, would encourage you to get connected with me. We have a really simple 3-step process, which includes your online application, a soft credit check, you upload some documents, and then we would use our scheduling system for you to schedule either a virtual or a phone call. Highly encourage the virtual session because then I can, do some screen sharing with you. We can see each other on camera, make sure that we understand, how we can best design these options for you. And this is a free service we provide for you. So whether you're, like I said, you're going to buy this upcoming year or beyond, at least you can have the basic blueprint in place for your home buying plan. And this is kind of the elements of that discussion, very similar to what we have in our class tonight. So you're going to learn a lot of the same things or concepts that we've talked about tonight, but we're going to kind of apply them to your own financial situation. And I wanted to kind of just share with you our mobile tool so you can start this process via mobile. We really embrace technology. Doesn't replace the human element of what we do. We're considered experts in our field. And so, we're always connecting with our clients, whether it's phone calls, text, emails, of course, Zoom and what we're doing there. But, certainly we want to leverage AI and mobile in everything we do. And you see that in a lot of our tools that we offer our clients. And finally, as part of our workshop series that we do for the Association of Former Students, you get these classes 4 times a year, but we also pass along a discount in our services. So whether you're going to purchase your first home with us or you're going to refinance with us one day, we pass along a discount in our services. And very similar to our partnership with A&M, we also have other partnerships all across the country. So if you have friends or family, maybe some coworkers that think might enjoy this content, or you want to share that YouTube video from tonight's recording, feel free to pass that along. We do have a few more classes left for this year. We'll have over 10,000 people sign up for classes with us this year. So we're super proud of that. And we're glad that you guys could be a part of that as well. And we do love what our community says about us, whether that's in some of the Reddit communities or online with Google reviews, or just some of our general Instagram posts celebrating homeownership and some of the testimonies we see from some of our clients all across the country. So we love for you to be one of those next testimonials about how your experience was with our partnership here at APM. So this is all my contact information. Love to be able to get connected with you after tonight's session. We've got a few minutes left before the top of the hour, but I will stick around for any questions. I see a couple in the Q&A, or the chat, I should say. I'll answer those now, and then feel free to start throwing some more questions out at me, and we'll make sure we get those answered for you tonight. So the first question was, if we want to build, does an FHA loan or conventional loan cover the cost of land and the construction of the home? So construction is a little bit challenging in today's market. We're building a construction product right now with APM. It's not under a conventional loan or FHA. It's kind of a privately funded type of situation. But with construction, you do have to acquire the land, which that's kind of the more difficult part is, if I'm going to buy a $100,000 piece of land, I have to get the financing for that. Generally, land financing is going to require at least a 0.5% or 50% down. So that's where there can be a little bit of a challenge, but it's not insurmountable. But we do get a lot of, kind of conversations like that going. So we can stay tuned on maybe our future construction product with you. Do mortgages apply penalties if you pay extra each month to reduce overall interest paid over time? So no, I mean, products that I offer do not have prepayment penalties. There are some exotic programs out there that maybe some lenders offer, but these are all very standard programs, all backed agency products. So the way that works is anytime you pay anything additional above and beyond the principal interest on your mortgage, that goes right to your principal balance. So for example, if I'm making a $2,000 mortgage payment and I'm going to round up to $2,500 a month, that additional $500 that I'm paying every month is going right to my principal balance. So yeah, there should be no penalties at all. You can make also lump sum payments if you want. So there's no issues with that. There is what we call recasting as well too, which, not to get too far in the weeds on this, but let's say I have a $400,000 balance and I came into a large sum of money and I want to put a $100,000 payment on my mortgage and drop my mortgage to $300,000. If I want my mortgage payment now to basically drop to like $300,000 as an equivalent payment, then you can do what he calls a recast, which basically says, hey, I just made a $100,000 payment. I have a 30-year fixed mortgage. I want to stretch my payments now for that $300,000 back over 30 years again in order to decrease my payments. So that's something you can do on most mortgages too. Hopefully that wasn't too complicated for you guys want to make sure that doesn't happen often, but it is certainly an option. Any other questions? I want to make sure I didn't miss anybody here. Okay, awesome. I think we got, and then question was, does recasting lower the interest rate? So yeah, the recasting doesn't change the interest rate at all. You basically have the same terms and conditions of your loan. It's just you're taking the advantage of recasting that loan back over another 30 years. So if you had paid 5 years into your mortgage on a 30-year mortgage, then it would take it right back over 30 years. So some clients may wait to refinance and do that big principal reduction. It just depends. Okay. All right. I think we did it. All right. And I gave you guys back 4 minutes in your evening. So that doesn't happen often, but I appreciate everybody's interaction tonight. Hopefully you had a few takeaways from tonight. We're here to be a support and a partner for you on this journey towards homeownership. I wish you guys all the best for a great rest of your week, and hopefully I get a chance to get connected with you soon. Have a wonderful evening. Talk to you soon. Good night.